Hello everybody, welcome back to The Contrarian. Today I have a very interesting topic I want to talk about, and that has to do with a recent series of tweets that Michael Burry has put out regarding the extreme condition that the market is in right now, and in his words, why the market is on a knife's edge. And he's mentioned this term before, and up until now we really haven't known exactly what he's been referring to in saying that the market is on a knife's edge. Of course, we've been able to guess that it has to do with the extreme valuations being placed on, stocks right and left, whether it be any sort of extreme example such as GameStop or AMC or Dogecoin, or could just keep listing off titles, or whether it be just the market overall being priced at extreme historic highs. But in this last series of tweets, Michael Burry has really clarified his statements in terms of what he is referring to in terms of the market being on a knife's edge. He's also provided a really interesting and short read that explains his epiphany of sorts that he refers to. So I'll just quickly get into his tweets and the article and then really give my thoughts regarding that. So his Twitter account, he recently reactivated his Twitter account. He has the habit of apparently deleting his tweets, which he does fairly often, so there's some kind of archives you can find out there, but this is actually an original tweet that he has not deleted yet. So if you're on Twitter, you can probably still see this, but it will probably be also deleted at some point in the future. So he says, if $5 incremental market value results from $1 added to stocks, and 90% of millennials, aka future wealth owners, are in passive market vehicles, that 5-to-1 ratio will get much, much sillier in time. COVID didn't stop it. Inflation might or might not stop it. Epiphany. And he references an article that I will look into right after this second tweet that he tagged. The first step is to recognize that 5-to-1 is not a natural ratio. It is a product of a paradigm. So what will continue this paradigm? What may reverse it? This is the knife's edge. Because we are at a 5-to-1 ratio, it might go to 100-to-1 or become -5 to -1, but parabolas don't resolve sideways. So now let's reference what Michael Burry is referring to. It's essentially this a release by the National Bureau of Economic Research titled "In Search of the Origins of Financial Fluctuations, the Inelastic Market Hypothesis." So this is essentially a hypothesis. It's nothing essentially that we know for sure, but it's an interesting read nonetheless, and it could very well explain what Michael Burry is referring to as the knife's edge. And I'll just read this briefly. We develop a framework to theoretically and empirically analyze the fluctuations of the aggregate stock market. Households allocate capital to institutions which are fairly constrained. For example, operating with a mandate to maintain a fixed equity share, or with moderate scope for variation in response to changing market conditions. As a result, the price elasticity of demand of the aggregate stock market is small, and flows in and out of the stock market have large impacts on prices. Using the recent method of granular instrumental variables, we find that investing $1 in the stock market increases the market's aggregate value by about $5. We also develop a new measure of capital flows into the market consistent with our theory. We relate it to prices, macroeconomic variables, and survey expectations of returns. We analyze how key parts of macrofinance change if markets are inelastic. We show how general equilibrium models and pricing kernels can be generalized to incorporate flows, which makes them amenable to use in more realistic macroeconomic models and to policy analysis. Our framework allows us to give a dynamic economic structure to old and recent data sets comprising holdings and flows in various segments of the market. The mystery of apparently random movements of the stock market, hard to link to fundamentals, is replaced by the more manageable problem of understanding the determinants of flows in inelastic markets. We delineate a research agenda that can explore a number of questions raised by this analysis and might lead to a more concrete understanding of the origins of financial fluctuations across markets. So while there's a lot of very technical language in this, this does explain a lot of what Michael Burry has referred to in the past in regards to his warnings about how passive investing can distort market prices. And the findings of this definitely indicate that the market is very distorted, if in fact this is true, where $5 in market value is added just from $1 being added to the stock market. That's an incredible uh, distortion in how the market should normally be working. It should be a 1-to-1 ratio. Obviously, right now, it's about 5 times away from that. Michael Burry suggests that it could go one of either ways. It could increase dramatically. It could go to a 100-to-1 ratio where you simply have the stock market just continuing to go parabolically up from here until it gets to a point of just insanity where the market's adding $100 of value for every $1 that's invested in the market or being added into the stock market. Likewise, it could also reverse. It could go to a -5 to -1 ratio, meaning that you were actually losing $5 in the stock market, in the total valuation of the stock market, for every $1 withdrawn from the stock market. And this is where the market is on a knife's edge, as Michael Burry has put it for a while, in that with passive investing especially, and as this finding was just describing how inelastic the market is. It's not elastic. It's not able to handle large inflows and outflows. And this is what Burry has mentioned before, in that likewise with a theater on fire with a very small exit door, it's just so inelastic when all of a sudden you have massive selling volumes and everybody wants to get out at the same time. It's just been a very gradual inflow with regards to passive investing over the past decade or more, of people gradually adding more and more and more into passive investing ETFs, which track index funds. And in doing this, essentially they're buying just a basket of underlying stocks, which are just decided upon by the whoever decides what is in the S&P 500, which largely doesn't change over time. So if a company is included in a index fund, they have a large advantage in that all of the ETFs which track that same index fund are all of a sudden going to be buying a proportional amount of shares. And the S&P 500 is a market cap weighted index, meaning that the larger the company gets, whether that be Amazon increasing dramatically in market cap or Apple or whatever, that also indicates that that is going to get an increased amount of inflow into that stock, because it absorbs all the more inflow simply because it's a market cap weighted index. And so this in large part does explain why Michael Burry has gone long the largest companies out there. Generically, he's gone long Facebook and Google in the past, and so this does explain why he is long some of the biggest market caps out there. It does also explain his strategy for going long and short at the same time, simply because the market could reverse this very quickly. It could go from, say it's a 5-to-1 ratio right now, say it goes to a 10-to-1 ratio and then begins reversing, where it goes to a -5 to -1. All of a sudden, Michael Burry's positioning plays out very well, in that he exposed himself to the long side through call options on these largest cap companies out there, but he also has exposure to the downside through shorting the most bubblicious stocks out there, such as Tesla, or whether it be shorting the bond markets, like he has also put a short out there. So all of this being said, these most recent tweets of Michael Burry's do really explain his his thesis out there as to why he believes the market is on a knife's edge, and why he believes that this won't last much longer. It could go on a little longer, it sounds like he's saying, but it might, in terms of time-wise, it could go on a little longer, but in terms of the real market action, it could be very all over the place. It could go up extreme and then down extreme. So all this being said, I'm not trying to provide any sort of financial advice here. I'm just showing how this really does tie a lot of Burry's past statements in together in these last few tweets that he's put out there. So all this being said, if you guys like this kind of content, just consider subscribing to this channel, and I hope to see you again at some point.